Thank you, Jonathan, for the introduction and for the invitation to present in the VIM seminar. This is a joint paper with Elio Bolliger, who is now working for the Swiss government, and Margaret Davenport, who is at King's College, London. And this is a paper on international financial contagion. And we're going to look at a specific angle, because we're gonna study the role of expectations for international financial contagion. So what do we mean by financial contagion, international financial contagion? It's when you have a shock to a given country that affects another country independently from that country's fundamentals. Right, so what are the sources of financial contagion across countries that people have looked at so far? Well, in the literature, there has been a focus on what we call funding shocks. This is a specific form of contagion that comes from shocks to the investor base of global banks. So, for instance, during the great financial crisis, global banks in advanced economies were hit by big financial shocks, and this translated to so this affected the countries where these global banks were investing. So, and in this way, the shocks translated from advanced economies to emerging economies. Okay, so this has been the focus of the literature. But the question we ask, what about expectations? Can expectations generate also some form of contagion between countries? And you may ask, but then how can expectations and expectation shocks generate contagion? So the answer we're going to give in this paper is that this can result from a combination of delegated investment. What does it mean? It means that if you're an investor and you want to invest in a country, say Brazil, you're not going to invest directly in Brazil equity markets, but you will typically invest in an equity mutual fund that has Brazil in its portfolio. So that's delegated investment. That combined with portfolio frictions. Typically, these mutual funds, and this has been already actually documented, typically they do not reallocate. So these mutual funds, typically they invest in many countries. So they have a portfolio allocation between these different countries. And this portfolio allocation is not updated very often. So this is what we mean by portfolio friction. So the combination of these two features can generate what has been called co-ownership spillovers, whereby expectations about the fundamentals of a given country, let's say Brazil, spill over to other countries that are held in the same portfolio. If you think, for instance, Latin America mutual fund that invests in Brazil and Chile, then because Chile is held in the same portfolio as Brazil, then it can get this type of spillovers from Brazil. For instance, what can happen is, let's say, an investor is optimistic about Brazil. He's going to invest in the Latin America mutual funds, but because Latin America mutual fund does not reallocate its portfolio shares toward Brazil, this means that Chile, which is in the same portfolio, is also going to receive some capital flows that were actually destined to Brazil. Okay, so I hope that mechanism is clear. Please don't hesitate to interrupt me if that is not. Okay, so this is the main mechanism we have in mind, and the contributions of this paper related to this idea are threefold. So first, theoretically, so we are going to introduce a model with delegated investment and sticky portfolios, and we're going to ask two questions. So first of all, when are there expectation-driven spillovers? And the answer is that that happens when portfolios are sticky. This is through the mechanism that I was explaining, because these funds are not reallocated towards, where they actually want to go. All right, but then there is another question. When are these spillovers important in the aggregate? It's not because there is this type of mechanism, it doesn't mean that they will be relevant. First of all, there is one reason is that expectations about Brazil might be correlated with expectations about Chile. In that case, if Chile receives capital flows that were destined to Brazil, it's not so bad because anyway, the expectations are very correlated. So the capital flows will be related to the fundamentals in Chile if the common component of expectations is very large. Okay, so Chile is going to receive capital flows that are not related to its fundamentals when there are some expectation shocks that are very specific to Brazil. Basically, investors think that Brazil is booming and not Chile, but still, through that mechanism, Chile can get those capital flows that are actually, really destined to Brazil. Now, so basically it's the idiosyncratic component of expectations that matter. All right, but then this is not enough because imagine that, there are some idiosyncratic expectations about Brazil, but also about Argentina, Ecuador, and all other countries that are in the Latin America portfolio. And then all these idiosyncratic components, they can, they wash out in the aggregate. Now, when are they not going to wash out? It's when there are some countries that are actually a big share of the portfolio. Okay, so if Brazil is a big component of Latin American mutual fund, then these specific, Brazil-specific expectation shocks are still going to matter in the aggregate for Chile. So the answer to that question, when are they important in the aggregate? The answer is when portfolio share are granular, meaning that they are not atomistic, when they are relevant. Okay, so the second contribution is empirical. We are going to use a dataset that links investors' expectations to two things, investments into mutual funds and to the fund's country allocation. Namely, so these mutual funds, they are managed by global banks. So for instance, you have UBS, it's global bank. UBS manages different mutual funds. So you have UBS Latin America, UBS Global, UBS Europe, etc. And all these funds have different countries in their portfolio. So we have the expectations of UBS relative to different countries and these countries' growth forecasts. Okay, so using this data set linking the investors' expectation to the investments into mutual funds and to the fund's country allocation, we can identify these spillovers at the micro, so fund and country level. And what we find is that, well, basically there are two elasticities. There is the elasticity of the investments into the fund. Okay, so basically the question is, how is, for instance, investments into UBS Latin America going to react to expectations about Latin America in general? That elasticity is high. And then there is another elasticity, which is the elasticity of country allocations within a fund to the expectations about the specific country. So that elasticity is, for instance, the elasticity of investment of the allocation to Brazil within UBS Latin America to the expectation of UBS about Brazil. And that elasticity is low. So the combination of a high elasticity of investments into the funds and the low elasticity of the allocations within the fund suggests that there is a high degree of portfolio stickiness. So there is room for this type of spillovers. And this leads us to the third contribution, which is the quantitative contribution. which answers the question, do spillovers matter in the aggregate? And in fact, they do. And the reason is very simple, is that actually portfolios, so mutual fund, these equity mutual fund portfolios are very concentrated. For instance, there are 10 countries that account for 65% of portfolios. So there are some countries that will matter in these spillovers. And then what we find, what we show is that what we care about is the extra volatility that a country is going to get that is unrelated to the country fundamental. That extra volatility we show is due to what we call the granular residual of the portfolio level expectation. Basically, what this is the weighted average of all the idiosyncratic country-specific expectations weighted by the share of each country in the portfolio. So basically, if Brazil is a large share of Latin America portfolio, then Brazil, the specific share to Brazil are going to matter. That will be in this granular residual. Now, quantitatively, this granular residual accounts for 25% of the expectation-driven capital flows in the aggregate for small countries. For large countries, it's much smaller. It's 7%. So really the conclusion of our study is that people have focused so far on these funding shocks that are typically advanced to emerging countries type of spillover. This mechanism is more of a mechanism that generates spillovers from large countries to small countries. So we contribute to different strands of this literature. First of all, I talked about this literature on the transmission of shocks at the mutual fund level. As I said, people have more focused on the funding shocks, and we show another type of spillover that is driven by expectations. Then there is another literature that looks at the elasticity of investments to expectations at different levels, for household portfolios, in housing, retail investors. Our focus here is the international dimension and the cross-country dimension. So people have shown that expectations about different assets matter for investment. We show that actually they do matter for cross-country equity allocation. And then there's the literature on the portfolio stickiness of those mutual funds. In fact, this has been shown already that the mutual fund allocation is sticky. And this is actually a fact that is more general than the allocation between countries. For instance, the equity share in household portfolios is very sticky as well. But what we highlight is that it's true that cross-country allocation within a fund is sticky, but this does not mean that capital flows are sticky. Actually, the flows into the funds are very elastic to expectation. It's the allocation that is not elastic. And we show that the combination of this high and low elasticity actually matters. Yes. Okay, so let me, if you don't have any question, I will start with the evidence, with our estimation of the elasticity of capital flows to expectations. Brief, summary of our data. We as I said, we combine two sources to construct our data. For the expectation data, we use the consensus economics data. We use the GDP growth expectations, so the country GDP growth expectations. So in this data set, so it's a data set of professional forecasts. Among the professional forecasters, you can find these global banks, so Bank of America, UBS. And you have their expectations on different countries, so on Brazil, Chile, China, the US, etc. We match these expectation data with a data set of mutual fund cross-country equity investments, which comes from EPFR. So in this data set, we have a lot of mutual funds. And for instance, we have UBS Latin America, UBS Global, etc. And for these mutual funds, what we observe are the assets under management, so the total investments into these funds, and we observe the allocation between countries. So this is the information we're going to use. So in the end, we managed to match 50 investors, and these investors, we index them by I, so this, for instance, UBS. We have 700 funds, which index by J, so that would be, for instance, UBS Latin America, UBS Global, etc. And we have about 50 countries, which we index by K. The assets under management, we denote by A, okay, so that would be the investment into a given mutual fund by a corresponding investor. And then the country allocations at the fund level, we denote by W. Okay, so this would be the allocation to country K in mutual fund J managed by investor I. So, okay, so as I said, there are two elasticities that we can estimate. The first one is the elasticity of the fund allocation. So within a fund, how is the capital invested between different countries? And we estimate how this fund allocation reacts to expectations. So for instance, think again of UBS, so that would be our investor. We observe their expectations about different countries. And then, so take, Chile, for instance, we observe the UBS expectation about growth in Chile in the next year. And then Chile will be held by a mutual fund, for instance, UBS Latin America. And then we estimate whether the allocation to Chile is going to react to UBS expectation about Chile. And this is what we find. So this is a growth expectation about the investor, UBS, for instance, about the country, Chile, for instance. And so let me say a few words about the controls. We control for, first of all, fund time fixed effects. So that accounts also for the investor time fixed effects, which will capture all the funding shocks that the literature has focused on. Okay, so if UBS is having, like some funding issues because of a, great recession, this is controlled for by these fixed effects. So we control for that aspect. We control for country time fixed effects, meaning here we will be controlling for every, macro development that is happening in the country. And importantly, this will also this will help us to identify what we call the partial equilibrium elasticity. Okay, why? Because these expectations about the country, Chile again, for instance, they are correlated across investors. So imagine there is like kind of a market sentiment that is very optimistic about Chile. So everyone is optimistic. Everybody wants to invest in Chile. But then in that case, then you observe, how much capital flows react to that expectation. However, the reaction of the aggregate capital flows is going to depend also on the elasticity of the supply of capital in Chile. So for instance, imagine that at the limits, it's completely inelastic. Then this increase in demand for equity in Chile is going to translate into an increase in equity prices, and in equilibrium there will be no capital flows. In that extreme case. So in that case, this will bias downward this our estimate, right? What we want is everything else equal. What happens when does the UBS mutual fund increase allocation to Chile when UBS specifically is optimistic about Chile? So that helps us. So this is what we're going to identify. And this means that this is really the partial equilibrium elasticity. What we are identifying is whether the allocation to Chile in a UBS fund is going to react to UBS optimism about Chile independently from other investors' optimism. Okay. So in principle, we don't have this downward bias. So what we find is an elasticity of 3%. What it means is that if UBS expects 1 percentage point higher growth in Chile, is going to increase so UBS Latin America is going to increase the allocation to Chile by 3%. For instance, if it was 10%, it will move from 10 to 10.3%. This is what it means. Now you can, yes?
Yes, I just have one question. So if I understand well this table, it means that all is in the same time t. So it does not. I don't see in this table what's happened if I think today that Chile will be. If I am optimistic about Chile today, what will happen tomorrow in T+1?
So this table tells you if you're more optimistic about Chile. If UBS is more optimistic about Chile, UBS Latin America is going to allocate more, a higher share to Chile. And quantitatively, here, this means that 1%, if you, let's imagine you move from 2% growth expectation to 3% growth expectation. The share to Chile is going to move from, let's say, 10% to 10.3%.
Yeah, but my question is more related to what will happen in the next months.
In the next months yeah, so this is a kind of a static elasticity.
Okay.
Right. Okay. It's right. So what you can is add some lags here. And when you add some lags, so we're not showing this because we wanted to focus on the static elasticity, that it also reacts with a lag to some extent, typically with a 1 month lag. But yes, there are some dynamic aspects that actually we neglect here. But this will give you kind of the average response, you know.
Yeah, you could also measure the persistence of expectations if you add lags, but you are right. I mean, in the world of finance, decisions are quick, so
I completely agree with you. This is actually an important question. Here, the thing is that we wanted, because the dynamic, reaction is actually very interesting. Here, we wanted to focus on the more like, the local within fund and into the fund thing. But yeah, you're right. There are some very interesting dynamic aspects that we could look at. There is some heterogeneity because, as you know, there are some funds that have a passive mandate and some funds that have an active mandate where they are supposed to update their allocations, whereas if they have a passive mandate, they are not supposed to. If you distinguish between these two, passive funds actually do not react, which is actually, expected. Active funds, when you focus on active funds, the elasticity moves from 3% to 4%, so it's a bit higher. But as you will see, it's hard to kind of at this stage, say that this is low or large. But as you will see, actually, this is not so large. It will be interesting to compare these elasticities of 3-4%, which is the elasticity of allocations within a fund, to the elasticity of the assets under management in the fund. So this is different. Now this is the second elasticity. Again, we're going to observe the expectations, the growth expectation of an investor, say UBS. These expectations now are aggregated at the mutual fund level. So imagine UBS Latin America. Now what we compute is the weighted average of the growth expectations about the countries in the fund, weighted by the allocation between these different countries. Okay, so we compute the weighted average of expectation for each fund, and we see to what extent the assets under management of these funds are react to these expectations. In that case, we have a regression at the fund level, okay, and we look at the impact on assets under management of a given fund to this weighted expectation, which is a measure of the kind of the average growth expectation for the fund. We here, because it's a fund level estimation, we can add investor time fixed effect that are useful, as I mentioned, to control for these funding shocks at the investor level. When we do that, we have an elasticity of 30%. Now, what does this mean? This is comparable to the other elasticity because it tells you what happens when you have a 1 percentage point increase in the growth expectation about the fund. And here, when there is 1% point increase in expectation about growth in the fund, the assets under management of the fund are going to increase by 30%. Okay, to compare to the 3% of the reaction of the fund allocation. And these are comparable because everything is in log. Okay. So this is relatively high, I mean, at least compared to the other elasticity. Okay, so we add some controls here, asset prices, the evolution of asset prices at of the equity in the fund. But what is really important are the last two columns, because there are some potential bias here. The first one is, note that we don't observe expectations about all the countries in the fund. Okay, so for instance, Latin America, we may have Brazil, but we may miss Ecuador and Argentina. So we have a missing expectation, missing variable bias, okay, because the expectations about the countries we observe and those we don't observe are positively correlated. Then that will generate an upward bias. So we need to correct for this. To correct for this, what we do is that we use what we call the granular residual. Let me explain, because this is also a good introduction to that concept that I will also examine later. Now, we need to make some assumptions about expectation. Sorry, this is expectation about return. This should be expectation about growth, but never mind. An expectation about a country, we assume, of an investor I, can be decomposed into a global component and a local component. Okay, so that global component will be the component is common to all countries. Local component is a component is specific to a country. Now, if we take that country expectation and we aggregate them at the fund level, meaning, so here I will compute the expectation, portfolio expectation for fund J. I will take the country expectations and I will weight them by the share of the country in the portfolio. What I will get in the end is a global component. Of course, this is common to all the countries in the fund, and a granular component. What is this granular component? Is the weighted average of the idiosyncratic component of each country. Okay, and that, if my assumption here is true, that will be orthogonal to the common component. That is the driver of the missing variable issue. Okay, so here I mitigate the potential for expectation about Argentina that I don't measure to drive a positive bias, because I'm using a measure of expectation here that depends only on the idiosyncratic shocks of the countries I observe. This should be orthogonal to the global component, which is the issue in the ones that I do not observe. So I hope this is clear. And in fact, when I use these granular components, I have a lower elasticity. So I did have a serious missing variable bias that I corrected. But that's not the same issue. Remember, when I estimated the country elasticity, the country share elasticity, I could add country time fixed effects, which I cannot do here. And these expectations and even the granular residual here can be driven by common market sentiment on different countries. Okay, so even the idiosyncratic component of Brazil that will weigh here, it can be correlated across investors, and it can drive a general equilibrium response that is going to mitigate the estimated impact. So to correct for this, we add another step, and we use what we call the super granular residual, which is the same thing as this, except that we subtract the consensus expectation. So I subtract from my granular residual an average across investors of that. Okay, so that this granular residual will reflect. So imagine Brazil is, is a big share of that portfolio. The idiosyncratic component of Brazil is going to weigh, but here it's not only the idiosyncratic component of Brazil, but it's really what UBS thinks specifically about that idiosyncratic component of Brazil specifically. So that should be orthogonal to market sentiment. And in fact, this actually generates a higher estimate because you don't have the general equilibrium effects that are going to limit the elasticity.
So one question?
Yes.
Yes, about this gamma. So it is not the excess expectation in the sense that we have an expectation that is shared among all players about this country, but we have an excess expectation from
the you can call it excess expectation of UBS relative to the excess expectation about Brazil. So there are two layers, and actually I can show you. The idea is that that Brazil specific component can be decomposed into a component that is common across all investors, that is common to the market, and one component that is specific to the investor. Okay, and this is the one we want to isolate. Okay, so this super granular residual is a weighted average not of this term, but on the term that is really specific to the investor. Okay, and
how do you measure you use consensus economics data to measure the overall expectation?
Yeah, exactly. I use the average across investors.
Okay.
About the country. Yeah. And then so just to take stock at this stage, the elasticity of assets under management at the fund level actually is quite high. I mean, it's quite a high elasticity of 43%, which is one order of magnitude higher than the elasticity of the shares within a fund. Okay, so already this gives you a sense of there is a kind of a substantial friction in terms of how capital is allocated within funds. But then in what follows, I will actually introduce the model, which will help us to discipline these coefficients and to give them like more interpretation. So the model is relatively simple. It's a two-period model. And there are M investors. The version I present, there is only one mutual fund per investor. The mutual fund actually can choose in the first period to allocate its wealth between a safe asset and a mutual fund. Okay, so just to simplify, in the paper we have a version with several mutual funds for each investor, but the mechanisms are very similar. And then the mutual fund, so investors choose how much to allocate to the mutual fund. And then the mutual fund allocates these funds to end countries. So according to some default portfolio shares with probability 1 minus P, and according to shares that are consistent with the investor's expectation with probability P. So this P is going to be a measure of the friction. The higher P, the lower the friction. If P is very low, it means that the portfolios are very sticky. Okay. Then the returns are realized, and it's a partial equilibrium model. Okay, just brief intuition about the model. As I said, we have M investors. Each invests in a mutual fund, and mutual fund allocate between the different countries the assets that the capital that is sent by the investor. And then there are two cases. If portfolios are flexible, and then if the investor is more optimistic about a country A, for instance, so we assume that the mutual fund shares the same information and is also more optimistic. If the portfolios are flexible, the mutual fund reallocates its shares towards country A, so that country A receives, the capital flows that are driven by this expectation. But if the portfolios are sticky, it means that, country A, on the one hand, will receive less than it was supposed to. Country B will receive part of the capital flows into the fund that were not destined to it. And this is what we call the co-ownership spillovers. Now, what does the model say? So we're interested into AIKT. So AIKT is the share of investor I's wealth that is allocated to country K. How does this depend on the different expectations? So it depends on the expectation about country K, but that elasticity depends on P. And the stronger the friction, the lower P, the less these capital flows will react to the expectation about the country. So take again Chile example. If the investor is optimistic about Chile, Chile is going to get some capital flows, but only to the extent that P is large. And then there is a role of the expectations about the mutual fund in general. So that expectation is also going to be driven by the large countries in the portfolio, say Brazil, for instance. And this expectation is going to affect these capital flows through two channels. First of all, well, not all spillovers are, inefficient. There is some amount of reallocation, portfolio reallocation, that is due, that is actually efficient. Imagine, and that depends on the covariance between the return in the country and the rest of the portfolio. And if this covariance is positive, then these spillovers are going to be negative. Intuitively, if you're optimistic about the other countries in the portfolio, let's say Brazil, okay. In that case, if the return in Chile are very correlated to the return in Brazil, then actually you're going to take some capital out of Chile into Brazil. Why is that? It's because, well, if the covariance is large, it means that they are very close substitutes. And if they are very close substitutes, you want your money in the country with the highest returns, which is Brazil. So, and this is actually negative, typically, when the covariance is positive. But then you have these co-ownership spillovers that are actually due to the friction. So as long as P is lower than 1, so as long as there is some portfolio stickiness, then expectations about other countries in portfolio are going to affect capital flows to Chile. Okay, so this is what the model says. Then what we want to do is to look at the aggregate capital flows. So we're going to aggregate this equation, okay, to get the total capital flows to country K, to Chile, for instance. And then these capital flows are going to depend on the investors' expectation about the country and about the investors' expectation about the mutual funds that invest in the country. And these coefficients, beta, eta, and phi times this covariance, are simply the coefficients that you have here. Okay. We simply collect the coefficients. So beta here depends on P, is increasing in P. Eta, which reflects the co-ownership spillovers, is decreasing in P, whereas the portfolio allocation spillovers is independent of P. Okay, and all these co-ownership and for portfolio reallocation elasticities, we collect them into delta, coefficient delta. Okay, so that's okay, and all this is weighted by the share of each investor fund in the total flows to country K. Okay, now let's look in more detail. We are going to, what we want to know is, to what extent are these co-ownership reallocations spillovers bad? So we take our decompositions the same as before. So the return expectation, we decompose them into a global component and a local component. So Chile-specific component, for instance. And as I did before, we're going to aggregate those at the fund level. and this is going to be weighted by the country allocation within the fund. And of course, you will get the global component because this is common to all countries, and the granular component, which is a weighted average of all the idiosyncratic components. So we're going to look at the contribution of each of these terms to the capital flows to country K. Then if you decompose the capital flows to country K into, three parts, there is a part that is driven by the idiosyncratic expectation about Chile. So that's really related to Chile's fundamental. This depends on beta, which is actually lower when the friction is strong, which is when P is low. And then you have the contribution of the granular component, where you have the ownership spillovers that are larger when the friction is stronger. Okay. Now, what we know is that the friction is going to affect these contributions. The stronger the friction, the lower the contribution of the idiosyncratic Chile-specific expectation. And the stronger the friction, the larger the contribution of this granular residual. And then what about the global expectation component? This is so. The question is, is that affected by the friction? And when you think about it, on the one hand, this global expectation component, Chile is going to get less of it through the reaction to Chile's expectation, and it's going to get more of it through the portfolio expectation, through the co-ownership spillover. And actually, these are going to perfectly compensate each other. And in fact, the contribution of the global component is not going to be affected by the friction. So the issue does not come from global component, it comes from the the granular residual is really the component through which co-ownership spillovers bite. Okay. And these are going, yes.
Yeah, I just have one question about the symmetry assumption. So yeah, it does not drive a bit this what you said?
Yes, your question is about those symmetries assumption. Yes, you're right. I need to make some assumptions. What I need to, this symmetry assumption, intuitively, obviously there are some countries that are going to get a bit more of the global component than what they should, and some countries that will get a bit less of them. But on average, a country is not going to get, on average, this global component is not going to matter. It's true that, so the symmetry assumption is to assume that on average, the expected return ex ante are not too different across countries, and that the hedging properties of each country for the rest of the portfolio are not too different across countries. In reality, they are, but on average, they are not. Okay. So if you don't believe in my symmetry assumption, at least what I can tell you is that on average, this will be neutral on average.
Mm-hmm. Okay. No, it's not. I'm not believing. I understand.
Oh.
I'm just believing that there is maybe another parameter, behavioral parameter, that is attention, that could change that could change this symmetry.
Very interesting. Very interesting. I don't think so. You know why? Because the P here, I just told you, okay, there is a probability that we update and probability that we don't update the portfolio shares. This is an ad hoc assumption. But actually, this in reality, this I believe can be driven by inattention. Okay.
Yeah.
Now, what you say that P might be endogenous and might depend on some rational inattention.
Exactly.
Okay. But in the end, wherever is the kind of the source, endogenous source of P, as long as there is some information friction that prevents, or some cognitive frictions that prevent from, perfectly updating This is going to hold. What can happen with rational inattention is that P could be state dependent.
Yes.
Yes.
Yeah. I wanted to ask this question about the control variables, if you control for volatility, for instance, or stuff like that. And then maybe you can find different results according to the state of volatility in the market. Or
yes. No, that's true. We can have some heterogeneity across countries, across time and states, absolutely. But this we did not do. But yeah, that's definitely a key question also for capital flows. That you know, this kind of parameters, they can change very quickly depending on the situation. Yeah. You might think that maybe in crisis time, P will be higher, which would mitigate these effects. Right.
Yeah, volatility is related to attention. Whatever rational or not rational, but it's related to attention. And then, and also if you have an asymmetry between the attention between two countries or two institutions, I think it could not mitigate, but just put into question this symmetry assumption.
No, absolutely. These symmetry assumptions are very useful for us because we need them to to say something like, you know, have a sense of you know, what really matters here, what is kind of the first order.
It allows you to build this model.
But yeah, I perfectly agree with you that there can be some deviations, and you can have additional terms to add here. So yeah, so basically the main conclusion is that, you know, coinertial spillovers really bite through the granular term. Another interesting implication is that if we identify this beta parameter here on the one hand, and this the part of delta that is due to the coinertial spillovers, which is eta, then the ratio between the two gives you a ratio of P to 1 minus P. So it could enable us to back out the extent of the friction. So now we come back to the data to bring the equations of the model to the data. And actually, there is a mapping for the model, from the model to the following specification. So we can, so we derive from the model an allocation level regression, which actually is exactly the same that we use to identify the elasticity of the country shares to the country expectation. I remember that elasticity was 3%. So 3% actually is beta. Beta, remember, is the elasticity of aggregate capital flows to the idiosyncratic component. And this is what we identified. And then we have also some fund level regressions. You know, where we regress the log of the assets under management at the fund level to the fund level expectations. And actually, this is also exactly what we identified with the second elasticity. That was so remember, delta is the reaction to the granular component, but when we aggregate, we also capture the reaction to the idiosyncratic components. So the elasticity of 0.43 that we identified is actually the sum of beta plus delta. But remember, delta actually captures all the different kinds of spillovers, coinertial spillovers, and portfolio reallocation spillovers. So we would like to disentangle these two. So now we need to expand this regression. And what we do is that, remember, these portfolio allocation spillovers, they also depend on some covariance. So we use that to estimate, on the one hand, a linear elasticity and an interaction term that actually will be capturing the portfolio reallocation spillovers. And when we do this, actually what we find is that beta plus eta is equal to 0.40. Okay, and then this portfolio reallocation spillover, there is some elasticity as well, but this is not as interesting. Okay, so we take stock of all these results. We can then derive eta okay, which is 0.40 minus, so 40% minus 3%, it gives us 37%. Okay, so eta is 37, is 0.37, beta is 0.03. Remember, the ratio of the two enables us to derive P, and P accordingly is 0.075. What does it mean? This is monthly data that we use. So this means that on average, portfolios are updated every 13 months, so every year. So this means that there is quite a high level of stickiness. This might seem high, but in fact, this is perfectly, I mean, this actually coincides with what other people have identified using different methods. And if you think, you can say, okay, but you have these active funds. What does it mean to be active if you update only once a year, right? But this is actually how active funds function. They typically don't change their portfolios all the time. They typically gather every year to, make strategic decisions on the portfolio for the next year. And then, okay, so taking stock again, portfolio allocation actually is relatively small as well. Okay, if we take our estimate. Okay, so now we have an estimate of the different key elasticities and parameters. Remember, we can decompose capital flows to a country using information on the expectations. Okay, you have the contribution of idiosyncratic components that depend on beta. You have the contribution of the granular term that depends on delta, which includes co-ownership and portfolio allocation spillovers. And then you have the contribution of the global term that depends on the sum of the two. So we can actually decompose capital flows using our information on expectations and our information on the elasticities. And we'll be particularly interested in the contribution of granular expectations, so these co-ownership spillovers to capital flows. We can compute for a country the contribution of the different granular terms of the different funds that invest in that country. Okay, so the granular components of the different funds will be weighted by the contribution of each fund to the total capital flows to that country. And then we compare this granular residual, which depends on eta, which we also identified. And we compare this granular term to the totality of expectation-driven capital flows that depends on the global component, idiosyncratic component, portfolio allocations, and that co-ownership component. Each component we construct exactly as here, using elasticities, corresponding elasticities, and the corresponding expectation. Okay, and here are the results. First, you can decompose expectations themselves. Expectations, remember, we assume that they depend on a global component and an idiosyncratic component. And what we see is that the idiosyncratic component accounts for 3/4 of the volatility of expectations. When we look at the capital flows implied by the model, the share of idiosyncratic component falls to 1% on average. Okay, why is that? It's because beta is small, very small. Beta is small compared to eta plus beta, which is 40, which determines the contribution of the global shocks, and eta, which is 37%, which determines the contribution of the granular shocks. Then between the granular shocks and the global shocks account for the majority, but the granular component actually is not, the co-ownership spillovers actually are not negligible. They are 17%, so that's the median. But you see there is a big range, so it goes from 8% to 48%. Okay, let me show you graphically what that means, and also let's distinguish between, on the one hand, advanced and emerging economies, and large and small countries. So this is the decomposition of expectations. What is in red is the contribution of the idiosyncratic term. So this expectation, big share is driven by, country-specific shocks. But when you look at the variance decomposition of capital flows, now the blue part, which is the global contribution, is the largest. But then the contribution of the idiosyncratic term is very low. Okay, that's because of the friction, right? And then you have the contribution of the granular term, which is actually substantial. It is larger typically for small countries and smaller for large countries. Now, large countries have another advantage. Okay, why? Because this granular term, because they are large, this means that the idiosyncratic, like, take for instance China. Okay, China, if China is in a portfolio, it probably accounts for 20% at least of the investment. So this means that the granular term here, 20% of it is due to China. So what we need to do is to reallocate that 20% to the idiosyncratic part of China. So we do this, we adjust for that aspect. And you see that this kind of improves things for large countries. The contribution of the idiosyncratic term increases. The contribution of the currency spillovers decline. This makes things a little bit better for small countries, but you see that it does not make such a big difference. Okay, so small countries are the ones that actually are most affected by these type of spillovers. Now, who are the contributors to these spillovers? Here we compute a measure of the contribution, which is the average share in portfolios multiplied by the standard deviation of the idiosyncratic term. It's a measure of contribution to co-ownership spillovers. And here we plot the average share of the countries of the country in the portfolio. And you see that this contribution is pretty heavily driven by the share of the country in the portfolios. So the biggest contributor is the US, because as you see, at least in our sample, it accounts for almost 1/4 of portfolios. And you do find some other advanced economies. You find the UK, France, Germany, Japan. So typically the G7 countries are there as the biggest contributors, but you also have large emerging economies. You have China, you have Brazil, Russia, India, Korea. So the BRIC countries actually are also big contributors. Okay, so here, as I said in the beginning, this shows you that this is really more of a channel of spillovers from large countries to small countries, and among those large countries, there are also some large emerging economies. Okay, so to summarize, what we show is that co-ownership spillovers, they matter at the fund level, but also at the aggregate level. So we estimate these elasticities of capital flows to country expectations, and we show that the relative elasticity of capital flows to country level and portfolio level expectations implies a high level of portfolio stickiness. Finally, this is a large country to small country spillovers. And in fact, those type of spillovers are, non-negligible for small countries. In those small countries, 25% of the variance of expectation-driven capital flows are actually unrelated to fundamentals in those small countries. Okay, I'm done. So thank you for your attention. Please let me know if you have any additional question.
Thank you very much, Kenza. This was a very, very deep understanding of granular expectation and funds. So really, thank you for this presenting us this paper. So please feel free to raise your hand if you have any questions. I will start with mine. It's still related to this symmetry issue. So don't you think that the figure that you've shown separates the big countries from the small countries in essence? And then because it is a big country and the small countries, and there is no symmetry between the countries, and which could explain some of the results. I mean, the size could explain some of the results.
Yeah, I mean, yeah, absolutely. What makes you a big recipient is when your country is, when the funds that invest in your country also invest in other big countries. Okay, so basically, when the funds that invest in your country probably are more of regional funds, I would say. Okay, so this we didn't explore yet, but I think it's very interesting.
Just to control the size of the country.
So the elasticities, you mean? Okay. I see what you mean. So what you suggest, let me know if I'm wrong, is to try to see if those elasticities, they depend on the size of the country.
Yeah.
Right. Okay, so one elasticity might depend on the size of the country is the allocation, is the elasticity of portfolio shares to expectations, because then that depends, because here I'm really looking at the elasticity to the country expectation, and here I can control for country size. So beta can depend on country size. However, the co-ownership spillover, this is really something that happens at the fund level. So if the elasticity is, depends on something, it will depend on the fund characteristics.
Yeah.
Right. So that will be more homogeneous. Right.
And you don't have also the size of the fund?
So if the elasticity depends, yes, I suppose this could also, size of the fund could be, but even if there is, so if there is some heterogeneity at the fund level, this heterogeneity will affect large countries and small countries in the fund portfolio in the same way. So I think
so the comparison could, at the end, the comparison is unchanged.
I think, not so much, because if you compare small and large countries, each fund has large and small countries. The beta is so small that I think that even if it was size dependent, it will not matter that much.
Very interesting. Feel free to raise your hand if you have any question. I will continue. I have a lot of questions, so sorry. But feel free to raise your hand. I will give you the floor to ask a question. So I have another question about your last point. When you say that 25% of the variance of expectation driven capital flow is unrelated to fundamentals in small countries. So just let's assume that you have a small country that is affected by a war, but the sentiment on it is quite positive. I'm not citing any country, but I think that your last point is okay. So if it is not driven by fundamentals, it could be driven by something that is not measured. So it could be sentiment, it could be something else. So do you think you could control for sentiment? And I have another question on sentiment, but I do think that there is something to do on the sentiment here.
Right. I guess, all these, so here we look at a specific driver of capital flows, which are our expectations, but there are definitely other drivers that can matter in a similar way, that can be affected by a friction. I'm thinking of geopolitical risk.
Exactly. I wanted to ask you.
Risk can drive capital flows into the fund, and then this fund can or not reallocate in a sticky way capital flows within the shares within the fund. This is there is actually a paper by Enrico Malucci looking at the role of geopolitical risk for capital flow allocation using similar data. But I would say that if portfolio shares are sticky to expectations, they will be sticky to other things. So I can imagine that you can have similar spillovers driven by geopolitical risk, at least in the short term, because I suppose that the geopolitical risk, it moves very fast, but then it's very persistent. So I suppose that
you can have a nice data set maybe to control for, which could be from volatility to geopolitical sentiment or risk, and sentiment, news sentiment or financial sentiment, that could not explain, but at least change a bit the results, or maybe explain this 25%, because I do think that there are some countries even today that are that could, be affected or not affected, but influenced by something else than fundamentals.
Sure. No, risk is a big one. Absolutely. You're thinking of like animal spirits, like maybe less rational.
No, not necessarily. Just news sentiment, volatility, and geopolitical risk. And if you can control for that, and I think you can find this
to some extent will be in the fixed effects, I would say.
Okay.
Country time fixed effects, as long as of course the identification comes from the investor specific expectation on a specific country or specific funds, and then everything that is common between the investors, this is in the fixed effects typically, which will be the case, I think, for a big part of geopolitical risk. But then maybe you're right, the investors, they might have different sentiments regarding that risk, and that could affect their expectations as well.
Yes, and
unfortunately, this I don't observe. I observe only
sure.
I observe only their growth expectation. For geopoliticals, it will be more difficult to identify, because I don't have this nice, investor specific, which actually was very useful for identification. But there are other ways to do this. I think this paper by Malucci would interest you because they use other ways to identify this.
I see. Very interesting. I just have one last question in case there is someone who wants to raise his hand to ask a question, but I just have one question about the data itself. And do you have funds that do not disclose their expectation or sentiment?
Some investors that do not disclose.
Yes.
Okay, so
you see where I want to go.
It's difficult to know because what I have, if I don't observe a growth expectation for a given country, it might be that they just don't produce a forecast for that country. Or they produce a forecast, but they just don't report it. This would be impossible to know.
Okay. Because I could imagine a fund that do not disclose its expectation, but still invest in another country. Then I would be curious
that's interesting. No, actually, it's a very interesting point. I did not think about this. Yes. Because I would guess that these investors, there are some countries for which they produce forecasts, and some countries for which they do not produce forecasts. But still, there are some funds that invest in both types of countries. And then it would be interesting to see how the fact of producing a forecast is related to, I guess that, it's both ways, right? If I invest a lot in a country, I would like to have more information. But then if I also produce more information, I can afford to invest more.
Yes, or it could
But
be
that's a
just a
very,
simple
very
policy
interesting point.
decision, because if I'm a founder and I don't want to disclose to others my strategies, then I would not disclose my forecast. Even if I produce them internally, I would not produce, I would not make them publicly available.
Yeah, this consensus economics, it's a bit in between, right? Because it's proprietary.
Exactly.
You need to buy
Yeah.
them.
Yeah, but others see them.
So they are not
so
public. So why do investors give their forecasts to consensus economics? Consensus economics actually rewards them by giving them some reports. But they don't give them access to the data, like the point estimates of, like UBS will not have access to the point estimate of UBS or of Bank of America, except if they buy consensus economics, but they have a report that shows kind of like a consensus and the trends and this kind of thing. So, yeah, but they still could buy the consensus economics, and if you buy them, you can have access to the other information, right? Then it's true. It question, what are the incentives to report truthfully the expectations about. But at least our results show that at least they put they put their money where their mouth is. Okay, so because the elasticities are positive, they do actually trust their own estimates.
Yes. Yeah. No, this I'm certain of that the vast majority is like that. My question is just in the case you have these funds that do not, what's happened?
No, it's a good question. Yeah. But there's some investors that so that would speak to the investor heterogeneity, because some of them are more strategic.
Or just yes, yeah, exactly. It could also speak to strategic communication. In the case,
Interesting.
I think it could be very interesting to discuss or explore. I'm pretty sure maybe the data could be hard to get or to identify, but in any case, could be very interesting to discuss.
Yeah. Yeah. No, and then I find interesting to look at the role of publishing or not a forecast.
Yeah.
Right.
Exactly. Okay. Do we have any questions from the floor, from the attendees? Sorry. Okay. So Kenza, thank you very, very much for being with us.
Thank you for the invitation.
It was a very, very interesting paper, mix between macro and finance that is, in my opinion, very contributive to the literature. So congratulations for this paper. And thank you very much for being with us again.
It was a pleasure. Thank you very much.
Thank you.